we've mentioned the fact that I suppose kind of, the tech-led trait of life, I suppose, is only going to continue. Things are going to become more techy. But a few questions, I think, touch quite an important point, which is about, valuation. You always need to consider valuations. And, people are asking things like, were IT-related tech stocks overvalued anyway before, recent events happened? Equally, pre-submitted question for the event asked, do tech stocks need a catalyst to re-rate to previous levels? And if so, what is that? Might be hard to guess there. Or do the panel believe multiples are permanently impaired? So I guess what I want to put to you guys, and again, feel free to volunteer, but, had valuations massively gotten ahead of us? And, where are we in relation to that now? Does it seem more natural place, or would you expect to go to the wonderful highs of 2020 again?
I mean, I can take a shot just to save the rest of the panel. Just look, I think as we think about, if we think about, kind of 2020 and the first half of 2021, look, I think some of the metrics that investors were using were probably not the right underwriting metrics. And I think that a lot of those metrics have gone away. And I can tell you for our fund, one of the exercises we did at the beginning, we started switching the fund a little in the back half of in mid-year 21. But one of the things we would have conversations where, if I worked, for example, with Dominic, I would just say, it just doesn't make sense, right? And we would trim positions, and sometimes we'd sell them. Not that we didn't think it was a great business, not that we didn't think that they were secular in nature. We just couldn't get the risk reward to work. And at the end of the day, I think as investors, the thing we're solving for is understanding what's the right risk reward associated with the business that you're investing in. And obviously, people underwrite with different methodologies, right? You could do a terminal cash flow. You can do near term. You might need to use a price to sales ratio, et cetera, et cetera. But understanding that, there needs to be a path to profitability. And I think that some of that mantra went out the window during, the somewhat euphoric times that we saw, kind of during the pandemic and kind of coming out of it. I think now, you're looking at companies that are more disciplined on their spending, which is a good thing. And at the end of the day, I just come back to the thought process that, the things that individuals and businesses learned during the pandemic, doing things digitally, taking friction out of how you kind of do things like customer service, all making people more productive if they're not in the office. Those are themes that are going to persist for a long time. And technology is the enabler for most of those things. So, I don't think, I understand where the investors are coming from, with the worry about, with the thought, was it a bubble? And it may have had bubble-like characteristics, but I lived through the dot-com. I'm probably the oldest person on this call. In fact, I know I am. There were some really bad businesses that were public that really weren't solving difficult problems. And I think today, most of the tech companies that, at least the ones we invest in, and I'm hoping that my peers on this call, what they do really matters, and what the problem they solve the problems they solve are difficult. So I always remind myself to ask myself, is there pain? How much pain is there for the customer? Because that usually means that the product is necessary. So, I will go on, but I do think that technology isn't a fad. And I think that, as egregious as some of the valuations we have gotten, I think we will go back to really thinking about this as a leader sector to lead us out from a market perspective.
Are there any kind of red flags that you would highlight for when something might be overhyped or might be a bit vulnerable and there isn't that kind of path to profitability?
Yeah, I mean, I always remind myself, if everyone's talking about it at a cocktail party, it's usually overhyped. And I can remember, the first beginning of crypto, where people had already gotten in, and then I was at a cocktail party. I said to my wife when I got home, I'm like, this crypto thing is bad, because I had many people that aren't professional investors telling me I should buy crypto. And I think a year later it was down 50%. And in fairness to the asset class, it's come back. So, and I'm not a crypto investor, but, I remind myself that, that Wall Street tends to overreact in both directions. And in between, there are opportunities to really make money as investors. And I think that what some of my peers have said in this call, you have to have duration. I mean, you said earlier in the call, you talked about 3 weeks, and I was just like, gosh, I just don't, I think one of the questions was about the 3 week time. We don't operate the fund in 3 week increments. Heck, we barely operate it in 3 month increments. What I want to do as a successful long-term portfolio manager is to figure out companies that are really going to have a multi-year cycle to them, and really continue to solve difficult problems for their customers. And let me tell you, if you do that, stocks take care of themselves, because investors figure them out and they want to own those businesses. So I'll pause to let the rest of the panel speak.